Let's also welcome on board Richard Jain from Motilal Oswal Financial Services. Also, Mayuresh Joshi from Markets Mind joining in on the show right now to talk about what they're feeling of the market. But Richard, let me start off with you. Afternoon, firstly. What levels do you foresee next as this struggle to get back to 26K continues?
Yeah, hi, very good afternoon to everyone. Well, I think the kind of broader market participation that we are witnessing now, it clearly seems that markets are set to resume its uptrend very soon after this last 2 3 days of consolidation, and also post that gap up opening which we recently witnessed. The index has held to its 20-day EMA on a closing basis. So I think we should surpass the 26,000 mark quite soon. The major hurdle for index would come around 26,400 if you look at bit positional basis, because even earlier in the month of December, 26,300, 26,400 acted as a resistance. In the month of Jan also, same resistance were there, and that gap up opening which we witnessed on 3rd of Feb has also registered high around 26,300. So I think the major hurdle is directly around the 26,300, 400 range. Till then, the momentum should continue on the positive side, and we should surpass that 26,000 maybe in next couple of trading sessions itself.
Okay. Mayuresh, what do you make of the kind of move on SBI today? I mean, we are now seeing SBI at probably 5-year highs where price to earnings ratios are concerned. I know we generally look at price to book where an SBI or banks are generally concerned, but now you're looking at maybe 5-year highs or maybe even decadal highs actually. I looked at only the 5-year data and therefore I have only the 5-year data. But yeah, how does it look now?
Afternoon, Harsh. I think stellar set of numbers.
Yes.
So on any count, whether you're looking at how the loan growth has been, upping their guidance from 12 to 14 band to 13 to 15% band, the NIMs have also been upped. So I think what they posted at 2.95%, the NIMs are expected to be around 3%. So I think the worst in terms of CASA deterioration is largely behind us. And for a large bank like SBI, I think where the elements were whether they'll be able to grow their balance sheet at a pace that the market really expects. They've probably done that, and they've outdone the market in terms of assuming that they will probably grow at 13 to 15% with asset quality staying pristine. Net NPAs have actually come down, which probably is a very, very healthy sign as we speak, and specifically in terms of the risk-weighted assets as a percentage of their balance sheet. The more interesting aspect, Harsh, however, came in through the YONO accounts. So I think the YONO account openings, which have probably happened, are also quite strong and robust. And they're actually boasting a database of close to 10 crore customers. So to that extent, I think it's a 360-degree performance that SBI has probably delivered. From a valuation perspective, it still trades around 1.7 times, which is still cheaper than a large part of the private banking pool. And therefore, I think stellar numbers, valuations on their side, and therefore risk reward probably stays on their side. Anybody holding SBI should hold SBI. I think the rating rankings as we see it in Markets with India look absolutely stellar.
That's quite interesting. That's the take coming in on SBI. Just looking at the lag end of the market as well. And today, Max Healthcare is seeing some more profit taking. REC is down 3.5%. We were chatting about an ICICI Bank, HDFC Bank. They as well are a lag. And Infosys is the other one, which is currently lower by about 0.5%. Kunal, what's the take now on the IT move?
So I think one should wait out for the IT stocks to bottom out, because this looks like that this could be a drag or a further corrective move for the IT index. What started off with a gap down previous week when the IT stocks or the IT index corrected from 39,000-ish mark towards 36, 750, 800 levels. Subsequently, over the next couple of days, the IT index has seen a follow through on the downside for itself. So from those 36, 750 odd mark, it's shed another 1,000 points to come back to 35,600. This indicates that there is a weakness which has started to creep into the IT index. Such kind of moves generally bottom out when these indices or asset classes, they come back into retesting the previous lows. And the previous low for the IT index, which was hit in the month of October, September end, was around 34,000, 33,750 mark, which means potentially another at least 1,000 points on the downside is what I would expect for the IT index, which could be 3% to 4% downside for the index and maybe 4% for individual stocks. So I would believe in that sense, would be on a wait and watch and not rush into this a bottom fishing kind of a mode for the IT index as of now.
Interesting. Okay. Britannia will also come out with numbers, in fact, and Snehi here with what to expect.
Well, yes, a good set of numbers is what we're expecting from Britannia yet again this time around. Just to let our viewers know, this is going to be the first earnings under the new MD and CEO, Mr. Rakshit Hargave, who assumed office on 15th of December of 2025. So on a consolidated year-on-year basis, we're expecting the revenue to grow by about 8.5%, EBITDA to grow by 12.5%, and net profit is expected to grow between 14 and 15%. And the margin is also expected to see an expansion at 19% compared to 18.4% this time last year, so a year-on-year uptick of about 60 bips, which looks very healthy as well. Overall, volume growth is expected to be between 7 and 8%, which was 6% on a year-on-year basis. And remember, in fact, in the previous quarter, due to all the GST disruption, it was a negative 3%. So this 7 to 8% number for volume this time around is also going to be a good show from Britannia. Grammage hikes in their LPUs, which is their low unit price, which makes up about 65% of their overall sales mix, will aid volume growth this time around. And roughly 85 to 90% of their portfolio has been affected by GST cut. So now all eyes are going to be on whether that GST impact, that transitory impact, is now behind the company or not. So finally, when the numbers do come out, watch out for commentary on growth and outlook by the new CEO, any new change in tone if we sense, any new management style if we're sensing based on the commentary. This is going to be important to watch out for. Demand outlook, raw material scenario, their pricing action, and commentary on rural and urban demand will be very important to watch out for. So yes, all eyes are going to be on Britannia this time around, but we're expecting a good show from their Q3 earnings.
Okay, thank you so much for that, Snehi. Now, of course, Britannia is one way to play consumption. The other way, Mayuresh, could well be through the jewellery names, and some very strong numbers that have come through on some of the jewellery counters, including the likes of a Kalyan Jewellers. The move of 7% today, likely warranted, given the way the numbers have panned out. How do you look at the numbers? Give us a sense. And how would you play consumption?
So, Harsh, I think various ways to answer your second question first. I think it's a very broad-based sector, specifically when it comes to India. And therefore, I think consumer staples, FMCG companies selectively, where there are leadership trades being displayed, is one way of playing consumption. Alcohol beverages is one space. Again, selectively, where I think the leadership trades probably exist. Apparel makers, domestic ones, who have a large presence in India, specifically tier 3 cities. I think that is where the consumption growth will come from. And last but not the least, I think on the consumer durable side, I think it's going to be a structural story over the next few years. But generally, I think being selective here as well warrants a stock selective approach. When it comes to Kalyan or the jewelry players in general, I think the expectations itself are low key. I think the expectations in terms of gold prices moving higher probably meant that the grammage sales would be relatively lower on a quarter-on-quarter basis. The studded jewelry part, again, is taking time to probably pick up. And again, with the foray of lab-grown diamonds specifically, I think that is creating huge competition as well. But for Kalyan, I think the numbers were better, much better than what was expected. I think what the company came out with, both in terms of the grammage number, in terms of absolute volumes, in terms of EBITDA number as well, I think that's where they came very, very close to what they were doing a few quarters back at around 7.5%. And if there is some element of improvement happening, I think that can create further leverage on the balance sheet. But I think this is clearly indicating that the wedding season is well and truly on. I think Q4 is where I think a large bulk of the wedding season will still continue, because till Jan 14th, I think till the Sankrant period was on, I think there was some slump in terms of marriage dates. But the fourth quarter is where I think the maximum impact will be felt. And looking at numbers, it seems that all the regulatory changes that have now happened, organized players are taking market share at the behest of unorganized ones. Therefore, strong set of numbers. Do I go out there and buy a Kalyan? My own sense is that Titan a tad bit better placed than Kalyan at this juncture. But generally, I think good numbers from Kalyan.
Come to you with regard to technicals and how some of these names are looking like on charts. 16% move on Kalyan Jewellers today. 2.5% plus on a Titan. Let's pull up a Thangamel as well. Try and see what that one's doing. Senco. All of these jewellery counters seem to be absolutely abuzz. 10% higher on a Thangamel, and a Senco as well, up 7%. What do you make of the kind of moves, Ruchit?
So it's clearly move that we are witnessing, the kind of volumes that many of the stocks have seen today, and the volumes are much higher than the daily average volume that we, especially stocks such as Thangamile is there, Titan is there, which is showing a relative outperformance since last few months itself. So I think that uptrend is clear signs that uptrend is likely to continue. So we like both the stocks, Thangamile as well as Titan, where a relative outperformance could continue. Kalyan from a pullback perspective looks good. It is now trading around its 50-day EMA. If this gets surpassed, then we can see levels around 480 kind of levels where 200 EMA is placed. Also, the momentum readings are in bit oversold. So clearly, the sectoral move is there. Most of the stocks within the sector has moved higher, which may continue for short to medium term. And Titan and Thangamala are two stocks which technically should show outperformance.
Right. Okay. Let's talk about Titan then. And that's all set to report its Q3 numbers. Snehi is here with all the details on what the ET Now poll is penciling in. Snehi?
Well, yes, all eyes are going to be on Titan's Q3 earnings, and this time around the street is expecting a very good show, a very strong set of numbers from Titan. On a standalone year-on-year basis, the revenue is seen at 21,092 crore rupees, a very healthy uptick of 31%. EBITDA is seen at 2,200 crores thereabouts, so 46.5% uptick over here too. Net profit is expected to go up by a whopping 52%, and EBITDA margins are also expected to expand at 10.5% compared to 9.4%, and this is very much in the management guidance range between 10 and 12%. So around that 11% mark is something that we were expecting this number to be. It's right there. So a good show is expected here too. Now, based on the management update that had come of a month or so ago, segmentally jewelry is expected to do very well. The street was expecting a 34% growth, but overall the management has indicated that this time around the jewelry growth could be 41%. Gold coins have nearly doubled in sales on a year-on-year basis. Plain gold category has also grown in late 30s, which is very healthy. Studded has clocked its best ever performance yet for FY26, and Studded has also seen double-digit growth in its mid-20s. Like-to-like growth for jewelry across formats is in low 30s. We were expecting a 27% around a figure over here, and low 30s sounds very good for the overall jewelry brand too. For watches, the overall growth of 13% is expected. Smart wearables are expected to still be sluggish with a cut of 26% on a year-on-year basis. For eye care, overall 16% growth year-on-year. Emerging business, we're expecting to see an overall growth of 14%, with fragrances up 22%. Women's bags expected to more than double. Taneira, we're expecting still sluggish move over here, and negative 6% degrowth is what we're expecting. And Earth, we're expecting 2 store additions on this front as well. The international business is set to have done well, 79% year-on-year growth, so we'll see what the final number here is. But when the numbers do come out, it's going to be important to look at the commentary on the response to recent lab-grown diamond launch of theirs, that new brand Beyond. Of course, commentary under the new chief in terms of jewelry. You have outlook on gold and diamond prices, Philip from the festive season, demand trends, profitability across segments, and competitive intensity and product mix, and especially the studded ratio is going to be important to watch out for. So yes, all eyes are on Titan. This time around, we're expecting a very good set of numbers.
Okay, thank you so much for that, Snehi. Kunal, I wonder if you're seeing anything within these jewelry counters. I know we've overdone jewelry today, but just the kind of move that's there on some of these names, including a PN Gadgil. Again, they've also come out with numbers, very, very strong numbers across the board. Titan, of course, awaited. What should one make of these moves?
Yeah, this indicates that money is moving back again into this space. Risk appetite coming back. Kalyan Jewellers specifically is a very high beta stock. So it's not just the price behavior of the stock price, but you look at the last 1.5 months, the stock was beaten down almost 100 points from, I think, 500 with the sell-off start for Kalyan Jewellers. The stock recently made a low of, I think, 340 or 360, and from 360 levels, the stock has come back towards 430 plus kind of a range. So this is now more of a repair process the stock is going through. Titan, on the other hand, the stock has been absolutely strong. It had managed to break past about the 4,000 levels. Maybe I think a couple of months back in the month of November, second half, or December first half, and from there on, the stock had actually continued to show signs of strength as well as resilience. So still looks to be quite strong on the longer term charts. But Kalyan Jewellers and PN Gadgil and such other names trying to make a comeback for themselves indicates that we are looking at the risk appetite being very strong. This could be momentum plays for the near term. So for traders who are looking at a time frame of say 1 week broadly, and with a swing target of say 5% to 7% further upside, they could look at a few of these options from a short term play.
The other space, of course, like we've been pointing out, look at a Crompton, and that posted a good set of Q3 numbers, while the PAT managed to miss the street estimates only on the back of the labor code impact. So largely would, call it in line, but, or rather, that was a miss. The revenues were in line, but it's a big beat when it comes to the EBITDA as well as the margins, and the brokerages as well are viewing the numbers very, very positively. Look at what some of the brokerages have said, and look at the kind of target prices that they are actually, now holding on with Crompton. Everything from a JP Morgan to a CLSA, Jefferies, they're all calling it a maintain to accumulate to buy, coming in from Goldman Sachs to Nomura, Investec and HSBC along with Jefferies as well. And the target prices are now ranging anywhere between about 280 all the way to 340 and 395 as well from some of the brokerages on Crompton. The con call takeaways, of course, they've talked about as to how the residential wires will now be available in the domestic market from March. The wires business is going to be outsourced initially with a capex commitment, and the foray into domestic wires, mobile accessories as well as power solutions is what they're now looking forward to in terms of diversification at Crompton. And I guess that's what explains the excitement that you're seeing on the stock today. That said, what else has been holding up? Just looking at some of the other buzzers. Kalyan Jewellers, by the way, is now holding up 13.5%, if you will. And SBI is now a solid 7% on the futures. Some of the realty names as well are making a comeback. And we were flagging off with Kunal earlier. Godrej Properties, that's looking smart. 1,800 on the share price right now. And it's a good 6% kind of move that you're seeing. Mayurish, your thoughts on realty? Has had its fair share of correction as well?
So afternoon, Aisha, I think to be fair and honest, yes, I think the underperformance probably has played out for the sector as a whole. And a lot of stocks had got beaten down for three major concerns. One, I think in terms of the inventory that a lot of these players possessed, there was some element of skepticism that these inventory levels might actually start inching higher every passing quarter with demand waning as we speak. The second element was obviously that there were very few pre-sales or new launches that were happening, resulting in pre-sales velocity. And as the revenue recognition is happening not on an accrual basis, but as it stands, I think that is where I think the expectation was that if there is an inventory built up and lesser pre-sales launches, I think the sales numbers might actually start coming off in terms of pre-sale collections. And the third was the leverage component. Is the leverage component going to come up? And therefore, I think a few players did stand out. Godrej Properties have reiterated their entire guidance as we speak, and therefore I think one of the strongest stocks, specifically when it comes to the real estate space, on all these areas that have probably embarked on. DLF has also very, very strong pedigree, both in terms of the residential and the annuity part of their business as well. And therefore, I think as interest rates are expected to stay lower, with a consensus of one more 25 bips cut expected over the next few months, I think that will translate into better borrowing costs for a lot of investors and retail participants as well, which would give fillip to the industry as a whole. So I think these two stocks might continue doing well. And one of the other stories, which has entered into a late stage base, Phoenix Mills, is doing phenomenally well. I think it was doing well over the last few weeks and months, and it has continued its good show as well. The only issue is that it has run up a little bit too much, and it lies in a late stage base as we see it. So I think even Phoenix, in terms of expectations of both their mall additions that are probably expected to happen, the fit outs, the escalations expected over the next few months, can actually play in its favor as well.
Ruchit, I wonder that in all of these stories, there's a Tata Steel, which has very silently crept up above the 200 rupee level. What next with regard to a Tata Steel, in your opinion?
So there's a continuation of this high top, high bottom structure. In fact, if you look at last 6-7 days, within the entire metal basket, the steel-related theme has started picking up now. Whether you see momentum in Tata Steel, Jindal Steel, SAIL, all these stocks have started witnessing higher volumes comparatively. So I think this uptrend could continue going ahead. If we take retracements of the previous correction, then it gives a possible targets around 210 to 212 range for the short term. So I think around 212 levels can be expected from a near-term perspective.
Okay. In fact, another set of stocks that have been in focus is the wires and cable segment. And Let's look at that segment. What's new? What's the demand scenario? Snehi is here to take us through a roundup with regard to how the numbers looked.
Well, yes, so if you take a look at the wires and cables segment, lots has been happening over there, but this is a more broader roundup on everything that's happened in the segment. So let's deep dive over here and take a look at what this segment has been doing, what the growth rate is over here. Now, historically, cables and wires are a segment that grow at about 1.5 times of GDP. But the kind of growth that we've been seeing in FY25, 90,000 crore rupees was the cables and wires market size in India, expected to inch up all the way to 1.5 lakh crores by FY29. That would imply a 5-year CAGR of 13%, and that in turn implies that this industry is growing at 2x the GDP growth from the traditional 1.5 times. So we're expected to see much more momentum in this sector going ahead. Let's understand where the demand comes from. The key end use sectors for wires and cables are power generation and TED, renewable energy, data centers, real estate, infrastructure, railways and metros, defense and EVs, manufacturing and semiconductors as well. Let's talk about how capex intensive this sector is and why cables matter to the busing economy of the country. Now, typically, a project spend for capex for wires and cables is roughly 3 to 3.5% of the entire overall capex spend of any project, because wires and cables are integral to any development, be it industrial, commercial or residential. Sunrise sectors that include this cabling share is renewables, data centers, as well as BharatNet, where we're expected to see the next round of demand for wires and cables coming from. Four structural themes to talk about when it comes to wires and cables. It's mid-teens growth visibility for the next 5 years. New entrants have arrived, but cable-heavy incumbents are better placed in the system, and we'll tell you why. Exports opportunity, India has a global share to rise multifold when it comes to the global share of exports of wires and cables, and margins are protected via fast commodity pass-through. Let's understand each one of these. The competition has heated up, no doubt. Ultratech Cement, Adani Enterprises, and in fact, the most latest, Crompton Greaves has announced a foray into the wires and cables segment, but this impact is expected to be limited. Why so? Because there are long approval cycles for the capex plants and manufacturing facilities for wires and cables, roughly around 3 years. Customized products will take time to make, and the existing players already have sticky relationships with some of their top clients, and new capacity is expected to be less than 5% of the industry. So not major impact expected, unlike something that we had seen in the paint sector. The export opportunity, let's talk about that for wires and cables. FY20 exports were at 4,900 crore rupees, FY25 at 14,500 crores. So that's a very big jump and a CAGR of about 24%. India's share in the global market is just 0.6%, which means there is huge leg room to grow over here also. And the key demand drivers here are going to be the China Plus One theme, renewables, and grid modernization from Middle East, Europe, as well as Australia. Lastly, we were talking about commodities. Let's understand what copper has to do over here. It's largely expected to be a non-issue because copper and aluminium price revision in that cycle happens every 15 days, and it is very quickly passed through to the end user, which means margins are largely insulated, and best placed segment within consumer durables is what wires and cables is. So that's a deep dive on the entire wires and cable segment.
Yes, but I'm curious to know how valuations reflect all of that, Snehi, and we'll try and get that perspective as well for you viewers tomorrow maybe. But the other stock that's in focus is a Jana Small Finance Bank. It's doing extremely well in trade despite a very, very poor set of numbers. In fact, let me read out those numbers for you. The net interest income went up 14% YOY, 9% QOQ, so that was impressive. But you look at the OPEX. OPEX has gone up 11% QOQ, 29% YOY. You've seen operating profit actually grow at just about 3% YOY. And you've seen provisioning at 277 crore versus 203 crore QOQ. That's a 36% uptick. So profitability completely erased. Just a 10 crore profit versus the 110 crore YOY number same time last year, of course. Now, in terms of, therefore, why is the stock flying, right? You've got the management come out and say that this was a kitchen sinking quarter. PAT guidance for Q4 FY26 will be between 140 to 160 crore. Credit costs will come off sharply from 280 crore to around 180 crore. The GNPA will remain largely stable is what they're saying. Cost of funds are expected to decline further, and there is a positive bias to NIM. So therefore, credit costs will decline very, very substantially from around 2.7% in FY26 to 1.7% in FY27. Margins will creep upwards. ROA will go to 1.5 to 1.6% from 0.1% this quarter. This is FY27, of course, and ROEs will be in the 14 to 15% band. This has obviously got the street enthused, and the stock is flying in trade, 14 to 15%. Mayuresh, I wonder if some of these small finance banks and banks which were exposed to the MFI cycle selectively could well be the pocket of value in this market, because they were trading at maybe 1.5 times book, and then they've got all of these problems which will likely get better in FY27. If you agree, could you also give us some ideas within this space that you're liking?
No, so I think there is always this hope and optimism that things will get better, but I think the numbers will testify that, and that's as simple as that. Having said that, I think a lot of initiatives have got announced in the budget when it comes to the SME and the MSME segment as well, which is going to be a huge enabler for this entire sub-segment. Again, let's not forget that a few quarters back, they also had a tryst in terms of the taxation issues generally for this space and the sectors as well. And therefore, microfinance lending, SME, MSME lending was under some element of lens as far as asset quality pressures are concerned. But the hope here is that as we enter the first half of the next financial year, things should get better. And with more regulatory oversight and with more financial assistance coming the way for these sectors in general, I think all the lenders are probably lending to this sector, obviously having a relative amount of cushion as far as their LTVs are concerned and the risk assets are concerned in terms of exposure to a particular set or a group or a subset of the MSME pool. I think that will probably do well. And having put that all in construct, I think Equitas is something that we continue holding in our swing portfolios.
Okay, just 3.5 minutes left to go before we wind up for the day. You've got GSK Pharma numbers as well, and optically at least they're looking quite okay. The operational first flash is really of the bottom line right now.